KKR releasing its latest review of credit and capital markets. It's titled V for Volatility Part 2. Joining us right now with the details is Chris Sheldon. He is partner and co-head of credit and markets at KKR. And man, has your heart rate slowed down yet from what you saw last month?
Yeah, I'm pretty calm. It's okay. It's actually the credit markets have been really resilient. I mean, I think if you look at the last 5 to 7 years, the credit markets have evolved a ton. It's no longer that high-yield bond and investment-grade corporate market that we all grew up with. It's public, private, corporate, asset-based finance. It's global, and it's so much more diversified. And so it's been pretty resilient from what we've seen in the last month.
Let me read some words back to you that you wrote in this latest report you've put out. The 10-year Treasury, U.S. Treasury yield surged towards its biggest 5-day increase since 1982. Followed closely by a sharp sell-off in the 30-year. Yield spikes, liquidity thinned, and what began as scattered signals became something closer to flashing warning lights. A good reminder for D.C. of the significant role a stable U.S. Treasury market plays. Do you think that message was received loud and clear, and do you think things have tamped down to a huge extent?
I think so. I mean, I think that's, as unsettling as that was, it was probably the best thing that could have happened. I think it was a nice shot across the bow, a reminder of the U.S. Treasury market is our stable, it's our ballast, and that type of volatility was caused without really the large foreign holders, China, UK, Japan, flexing. Right. And I think that we need that stability, and I think that was a great reminder for D.C. in terms of let that happen again. And
so cooler heads, you think, prevail from here?
I think some cooler heads prevail from here. I think unlike previous periods of volatility that we've seen, whether that be the big periods of volatility like the GFC or COVID, there was a lot of uncertainty out there, but we didn't know what to do. Like, we could stop this volatility pretty quickly if we wanted to. Now, I'm not sure we will.
Stop it how?
Well, trade deals.
Oh.
Yeah, or retreat. And I'm not saying that will happen, but it's a lot different of a
So you're not talking Treasury or Fed actions, you're just talking policy actions.
Correct.
Yeah.
Correct. And the economy feels in good shape. What we're seeing across our 2,000 portfolio companies, in credit, we're seeing still growth. We've seen increased dispersion in the last 12 months. We have seen some slowing, but we've been in this rolling recession where this volatility is not equal to every sector.
So is the problem in some areas that companies don't want to take on loans because they don't have certainty about the future, or like the money's there if they want it?
For sure, capital markets activity is slowing, and the longer that we have this volatility, the longer that this extends, yes, we'll have a little bit more volatility for sure. We are seeing a slowing of that capital markets. We do need that grease in the wheels to keep that going. But we're also seeing, because of the maturity of the credit markets and how much it's evolved, we've seen it go away from public markets to private markets. There's a lot more options for companies for financings. We're seeing an increase in pipeline in more bespoke capital solutions.
Sure.
We're seeing capital flows to Europe. I think this is good for Pan-Asia trade. And then so as a result, that's my point, is this volatility is not necessarily just all equal to everything.
I think that same sort of optimistic tone has been what's been echoed out at the Milken Conference in California right now, that people are looking at this as, okay, more complicated in some levels, but hey, there's a silver lining to all of this.
For sure, and I just came back from that conference, and the optimism was there, a lot more than probably what I expected.
Can I ask you about that?
Yeah.
So I was there on Sunday night.
Yeah.
And I wasn't there the whole time. There was a dinner.
Yeah, I heard about this dinner.
Okay.
Yep.
150 people. I don't know, maybe 200.
I heard like 4 people raised their hand or something.
You heard about this?
Yeah.
Okay. You heard? Yeah. So
hey, fill in the rest of us. 4 people.
So the rest of the story is, I actually said to the room, I said, how many people here are optimistic about the economy over the next 6 months, right? Yeah. And it wasn't even 4. I would say 2 people raised their hand. Then we asked the question, 12 months out, maybe, I don't know, 10 people raised their hand. By the way, all these people are famous people who are investors. It wasn't until we got to about 24 months or maybe even 3 years out, as I joked at the time, either the end of the Trump administration or the beginning of the 3rd term, that anybody was super optimistic. So when people say that people at this conference are so optimistic, I was like, what are they talking about?
Yeah, I mean, that was the one area where I didn't hear optimism. I had a lot of meetings. Everyone was sort of constructive. And I think maybe it's a difference of where you're constructive and what markets you're constructive. Most of the people I was meeting with, and I had a lot of client meetings, a lot of LP meetings, very constructive on the credit markets. It feels like there's a lot of dry powder out there. There's a lot of liquidity. We've been in an environment where supply and demand has been out of whack for a little bit. And so I think people are waiting to sort of see a little bit of that sell-off to sort of lean in.
Constructive from the perspective that the money is there, the availability for credit is there, but there's nobody who really wants it yet?
Well,
or constructive
people
from the,
want it. I think
I'm
what you're
going to jump
seeing,
in at this price.
Yeah, I think, well, there's a price and there's a public markets. I think there's still a huge demand for financing out there. I think you're seeing it. Obviously, there's a lot of dry powder in private equity that still needs to get deployed.
Yeah.
There's a lot of financing needs for large corporates. We're seeing a big trend. If you are a capital-intensive company, your stock has been relatively flat. If you've been a capital light, you're getting rewarded in the equity markets. So you're seeing a lot of activity of taking hard assets, recurring revenue streams, financing them off balance sheet, almost similar to like a sale-leaseback model.
Or like what Disney is doing, licensing to have somebody else pay to build the next
Take
park.
that cash,
That's
use that for growth
yeah.
other places. So as I sort of go back to that credit market is no longer just the lev fin market. It's asset-based finance, it's structured alts, it's private IG, it's global, and you can now, as a allocator or an investor, you can do that in scale and ease, and you can get diversified income on, which was not the case a few years ago.